This lecture, Canada and the Depression, will focus on the key contributing factors to Canada's economic downfall during the 1930s. From riches to rags. The 1920s had been a time of unprecedented prosperity for many Canadians. However, the economy was beginning to have problems. The economy is commonly looked upon as a cycle, more specifically the business cycle, comprised of the prosperity phase, the recession phase, the trough or depression phase, and the recovery phase. At this time, the economy was seen as a natural cycle that would ultimately correct itself through competition as well as supply and demand of products. The business cycle revolves around the production of goods and employment needs. When a company is producing lots of products for consumers, they will need employees to help make the products. When people, or consumers, stop buying goods, this will affect the production level of companies and, as a result, employment needs. Read over each of the different phases of the business cycle closely. What phase of the cycle are we currently in? The 1920s and the stock market. During the 1920s, many people invested in the stock market. Many borrowed money to buy shares. The value of shares or stocks increased dramatically. This is known as a bull market, when there is a sudden surge in the market. Individuals made significant profits if they invested correctly. What caused the stock market crash? In September of 1929, the value of stocks began to decline. Some economists had previously warned of an impending economic collapse, but had been ignored. People began to panic and sell their stocks in order to regain any money they might have. Black Tuesday. On Tuesday, October 29, 1929, the Toronto, Montreal, and New York stock exchanges crashed. Many companies went bankrupt, and those whose companies did not had the value of their shares drop by as much as 50%. There was a panic, and many stormed the banks to withdraw their money. However, banks had closed. Sadly, the suicide rate rose during this crisis. The day the stock market crashed. In New York, the streets were flooded with men who had lost all their investments. Many could not go home to tell their families that they had lost everything and that their lives would drastically change. The stock market crash in Canada. Few Canadians own stocks. However, the American and Canadian economies were directly tied. Canada exported many products to the United States. Many of the companies who bought Canadian products were now bankrupt. There was little demand for Canadian products, and, as a result, the Canadian economy began to suffer. The start of the Depression. The stock market crash helped trigger a decade of hardship for many Canadians. The stock market crash should be viewed as a trigger effect that helped start the Depression, but was not the central cause. There are 6 central causes of the Depression that we will take a close look at. Overproduction and overexpansion. Dependence on few primary products. Canada's dependence on the U.S. High tariffs or trade taxes that choked off international trade. Too much buying stocks on credit. Too much buying on credit in general. Number 1, overproduction and overexpansion. Too many products have been produced and left unsold. Factories and other businesses had expanded beyond their means during the 1920s because business had been good. Production began to slow, and as a result, employees were laid off. People had less money to spend. Number 2, Canada's dependence on few primary products. Canada's economy relied too heavily on pulp and paper, mining, wheat, and fish. When the demand for these products decreased around the world, the Canadian economy dropped. For example, European demand for wheat decreased. Canadian farmers had difficulty selling their wheat as a result. Number 3, Canada's dependence on the United States. The Canadian economy was very closely tied to the American economy. 65% of imports came from the U.S., while 40% of Canadian exports went to the U.S. When the stock market crashed and the Depression started, it inevitably hit Canada hard. This cartoon details the close connection between the U.S. economy and the rest of the world, including Canada. Our dependence on the U.S. had proven very profitable during the 1920s. However, it resulted in Canada's economic collapse in the 1930s. Number 4. High tariffs choked off international trade. Countries would increase tariffs, or a trade tax, on imports to protect industry within their country. As a result, Canada couldn't export as many of their goods. Canada relied heavily on exporting natural resources and goods to foreign countries. Trade walls prevented Canada from selling its products worldwide, especially in the U.S. For a closer analysis, take a look at the example provided. Number 5. Too much buying on credit. Canadians were encouraged to buy now, pay later, a familiar mantra for our country today. Cars and home appliances were bought on credit and paid off using monthly payments. Interest charged on these products made them very expensive in the long term. When people lost their jobs, they had no money to make these monthly payments. Number 6. Too much buying of stocks on credit. People bought stocks on credit, also known as buying on margin, and paid back their debts with profits made on the stocks. For example, $1,000 worth of stocks bought with only a $100 down payment. The value of stocks increases to $2,000 and the debt is paid off and there's $1,000 of revenue. However, if the stock value decreased, the shareholders had no money to pay back their creditors. The Depression begins. At first, many thought that the economic slump would only be temporary. As discussed earlier in the presentation, the economy was viewed as a cycle that would naturally correct itself over time. However, the 1930s would be a time of extreme hardship for Canadians. Unemployment, starvation, malnutrition, and a lack of basic necessities would become a common struggle for many Canadians.